USDA loans are government-backed mortgages designed for low to moderate income borrowers purchasing homes in eligible rural areas. Despite the name, many people are surprised to learn that a large portion of the country qualifies as USDA eligible. These loans are attractive because they offer zero down payment, lower interest rates, and lower mortgage insurance compared to FHA. These are for primary residences only. USDA loans have two primary eligibility requirements: property location and household income. The home must be located in a USDA designated area, and you can check the eligibility using the USDA property eligibility map, which we've linked below. Household income must not exceed 115% of the area median income for the location. Two important clarifications you should know. USDA looks at total household income, not just the income for the borrowers on the loan. This includes all employed household members over the age of 18, whether they're on the mortgage or not. This is one of the most common reasons USDA loans fall apart if not reviewed up front. Debt to income and credit guidelines for USDA loans typically aim for 41% maximum debt to income ratio, though exceptions may be possible. Because USDA loans are government guaranteed, lenders may allow flexibility based on strong credit, stable income, and reserves. USDA does not typically set a minimum credit score, but most lenders will have their own minimum requirements. USDA loans do have mortgage insurance or guarantee fees, but it's often misunderstood. There is an upfront guarantee fee typically financed into the loan, and there's also a monthly guarantee fee, which is generally lower than FHA mortgage insurance, and this is one of the reasons why USDA loans are such an affordable option for qualified borrowers. In addition to the standard USDA guaranteed loan program offered through lenders, the USDA also offers USDA direct loans for very low and low income borrowers. These loans are issued directly by the USDA, offered with terms up to 33 or even 38 years, and designed to make payments extremely affordable. USDA loans allow seller concessions up to 6% of the purchase price. These credits can be used to cover closing costs and prepaid expenses. However, seller credits cannot exceed actual closing costs and cannot be used for down payment. Manufactured homes can be eligible for USDA financing, but the requirements are strict. Key requirements include that the home must be new and never previously installed or occupied, purchased from an approved dealer or contractor, built within the last 12 months, and the size and construction requirements are as follows. For a single wide, it must be a minimum of 12 feet wide with 400 square feet. Double wides are a minimum of 20 feet wide, and they must be attached to a permanent foundation. Additional requirements include a HUD certification label on each section, classified as real estate and taxed as such, located above the 100-year floodplain, and must have approved water access and wastewater disposal. Like other government-backed loans, USDA has minimum property requirements. The home must be safe, sanitary, and free of health and safety hazards. Depending on the property, inspections may be required for termites or pests, septic systems, and private wells. If you currently have a USDA loan and are refinancing into another USDA loan, you may qualify for a USDA streamline refinance. This option typically requires no appraisal, minimum documentation, and reduced verification requirements. It's designed to lower your interest rate and monthly payment with minimal friction. USDA loans are one of the most underrated mortgage programs available. For buyers that qualify, they offer some of the best affordability on the market, often outperforming FHA and conventional low down payment options. If you found this video helpful, we'll really appreciate it if you subscribed or followed us on other social media platforms for more clear, practical mortgage education content. Thanks for watching.